Hello everybody. This morning I'm going to make an update on the technical outlook of the S&P. So we are going to study a few cases which are the top formation of 2000 as we will see very quickly and 2007. After that I'm going to comment the major sector rotation we saw in Europe. Of course I'm going to focus on European markets. So major sector rotation in October and what it means for the market. So first, this is the monthly MACD. So as I commented on Wednesday in my daily mail of Wednesday, major MACD sell signal at the end of October on the S&P 500. So this is a quite major technical event showing that the momentum, the long-term momentum of the S&P 500 is starting to deteriorate. As you can see here, over the last 20 years, we saw less than 10 similar signals, so sell signal, and especially we had similar sell signals near the top of 2000, so at the start of the bear market, also near the top of 2007, another bear market, and the third good signal was registered in early 2015 at the start of a significant correction of the market. It does not mean that the monthly MACD is always right. As you can see, half of the signal were not very good. This was the case of the sell signal of 2011, and we had a couple of wrong signals before the start of the bear market in the late 1990s. But overall, I would say that half of the signal were good. So it means that there is a 50% probability to start a bear market within coming months on the S&P, which I find is quite high in terms of probability. So now we are going to focus on the two interesting periods to study, which could be potentially similar to what we are seeing right now. This is the top formation of 2000 and also the top formation of 2007. First top formation, so in 2000. So the top of the market was seen in late March. So here you can see a typical top formation with a breakout above previous highs, a kind of panic selling moves. So bulls are becoming more confident, bears are cutting their exposure, so they are whipped out of the market. Then you have the top and the reversal, and the move back into the trading range and the invalidation of the bullish signal. This is something that happens very often at the top of a market. So a false breakout, then a move back into the trading range, a very sharp correction, and after that a squeeze, and you have some whipsaws for a couple of months. Then after that the real correction. So this is quite interesting to study this period and to compare it to what's happening right now. So we had in April, May an initial correction, then a very strong recovery with the index retracing around 61.8% of its pullback, then going down again, going up again, and so on, and it lasted until August. And as you can see, the peak of the market in August was quite close to the high of March, April, with the index retracing more than 76.4% of its correction. Which means that between the top and the real downside acceleration, there could be an extended period, so in this case 5 months. So you can see that the real correction started in late 2000 and also the market accelerated upwards the next year. When we look now at the top formation of 2007, a very similar technical pattern. So the breakout in October, so this was the top of the market. So false breakout. So bulls are becoming more confident. Shorts are squeezed out of the market. Then we have the false signals and the start of the correction. So once again, you can see that there is a significant correction starting in late 2007, then a big squeeze with index once again retracing around 61.8% of its previous decline. And in this case, as you can see, the bear market started quite quickly because after making a short squeeze, the market directly dropped and the downside acceleration occurred in January. So right now, if we compare the top formation of 2007 and 2000 as well, you can see this squeeze here. So this was in August and September. So a full subside breakout. Then after that, a move back into the trading range. So an invalidation of the breakout in October. So we saw a big drop of the market in October, break below the 200-day moving average. So a sharp decline. And after that, the famous short squeeze with index retracing like in 2000 and 2007. 61.8% of its previous correction. So once again, as you can see, the market, usually the retracement after the initial correction is quite strong, around 61.8, which is the reason why I was expecting in the event of a significant squeeze, such a technical bounce. And I don't think it's because we saw this technical bounce this week that you have to buy the market. I think on the opposite, that the squeeze we saw this week could be an opportunity to reduce exposure to the US market, or even if you're waiting for a technical bounce to sell the market, it could be a good opportunity to start selling here. Just a comment before switching to sectors. As you saw in 2000, it's not because I think that the market can continue its correction that tomorrow the market will decline. If we look at the top formation in 2000, it could be something like that, and later in a month or two, which will probably be in this case January, we are likely to see the market accelerating downwards. So before that, the market can continue to whipsaws and will not necessarily retest soon the lows of early November. Now if we switch to the sector outlook, so this is my ranking system on European stock sectors. As you can see here, so this is the publication I wrote on Monday with an update of monthly ratings, so at the end of October. So as you can see in this matrix, especially on the x-axis, which represent the monthly ratings, October was a massive month in terms of sector rotation, with something that I have never seen in a couple of years. I would say even since I started this ranking system, which is a massive deterioration of the monthly outlook on two sectors, industrial goods and services and chemicals, with a triple monthly downgrade. So last week, this sector have the strongest rating, strongest monthly rating, and they now have the weakest monthly rating. So it shows a massive trend deterioration of the long-term outlook on these cyclical sectors. On the opposite, three sectors are becoming market leaders: food and beverage, media, and utilities. So it shows that the market is starting to discount something, probably a deterioration of the economic outlook, of the economic growth, something that economists have not yet priced in. And this is very interesting, I think. Another sector that experienced a significant downgrade is the technology sector. So as you can see, this sector moved from the right part of the matrix to the left part, which shows that the medium-term outlook of the technology sector is also deteriorating. I will just show you now one chart to end this presentation. This is the stocks industrial goods and services. So on the upper part you have the absolute charts. So as you can see here, a massive breakdown in October, a break below the 200-day moving average, a confirmation, a top formation validated. So this top formation formed over the last year, even more, longer than a year. And you can also see the major breakdown of the relative chart. So here you can see that both in absolute and relative terms, the industrial goods and services sector broke down in October. And this is not because we are seeing a technical bounce right now due to oversold condition that you have to buy this sector. I think on the opposite, you have to sell it. You have to reduce exposure to industrial goods and services because of this trend deterioration. And I see the current technical bounce on industrial goods and services as a selling opportunity. Have a nice trading day and a good weekend.